Every single morning, millions of retail traders in this country do the same thing. They identify a level, they wait for a breakout, they enter, and then the market reverses directly into their stop loss. Then it continues in the original direction without them. This is not bad luck. This is not a random market. This is a pattern. And once you understand the institutional mechanics behind it, you will never look at a chart the same way again.
Today, we are breaking down the market structure blueprint. This is the exact framework that institutional traders use to read price action at a structural level, and how you, as a retail trader, can identify smart money positioning shifts before they're confirmed by price. Let's get into it. Before we talk about identifying smart money, we need to establish a baseline understanding of what market structure actually means. And I don't mean the textbook definition. I mean the functional definition used by professionals. Market structure, at its core, is the sequential pattern of swing highs and swing lows that price creates as it moves through time. That's it. Every trend, every reversal, every consolidation, it all reduces to how those swing points relate to each other. In an uptrend, you have a series of higher highs and higher lows. Each rally pushes above the previous peak. Each pullback holds above the previous trough. Price is making progress. Buyers are in control, and sellers are being absorbed at higher and higher prices. In a downtrend, you have the mirror image: lower highs and lower lows. Each bounce fails below the prior high. Each decline breaks through prior support. Sellers are in control. Now, and this is critical, the moment this pattern breaks is the most important event on any chart. When an uptrend creates a swing low that goes beneath the previous swing low, that is called a break of structure, or BOS. That single candle is telling you that something has shifted in the supply-demand equation. Smart money doesn't announce what they're doing, but they can't hide their footprint entirely, and that footprint shows up in market structure first, before any indicator fires, before any headline breaks. Let's talk about institutional participants: hedge funds, bank prop desks, asset managers running billions of dollars. These are the entities that move markets. And here's the fundamental problem they have that retail traders never think about. They cannot just buy or sell whenever they want. When you have $2 billion to deploy in the S&P 500 or a $500 million position to exit in crude oil futures, you cannot simply hit the market order button. You will move the market against yourself and destroy your own fill quality. So what do institutions do? They use time and levels to build or unwind positions in phases. The classic model, often attributed to Wyckoff analysis, still highly relevant, describes 4 phases. Accumulation. This is where institutions are quietly buying, usually in a range or after a downtrend, while retail traders are still bearish and selling. Volume is elevated, but price is going sideways or making subtle higher lows. Retail sees nothing happening. Institutions are loading. Markup. Price breaks out of the accumulation range. This is where retail traders notice the trend and start buying. Institutions are already positioned. Distribution. At elevated prices, institutions begin offloading. Price may still be making new highs, but each high is met with heavier selling volume. Retail traders are most bullish right here, at the worst possible entry. Markdown. Price declines as institutional selling overwhelms retail buying. Retail is holding losses or entering short too late. Understanding this cycle doesn't give you a crystal ball, but it gives you a framework for asking the right question on any chart. Which phase is this asset currently in? Now, let's get into the specific signals you should be watching for on your charts. 2 terms that have become foundational in modern technical analysis, particularly in the smart money concept framework, are the change of character, CHoCH, and the break of structure, BOSS. Break of structure, BOSS, is a continuation signal. It occurs when price breaks a swing high in an uptrend or a swing low in a downtrend in the direction of the prevailing trend. It confirms that the current momentum is intact. Institutions are still accumulating or distributing. You want to trade with the boss in a confirmed trend. Change of character, or CHoCH, is the early warning signal. This is what we're really hunting for. A CHoCH occurs when price, for the first time, breaks a swing point in the opposing direction of the current trend. In an uptrend, the CHoCH is when price breaks below the most recent higher low for the first time. This is the first structural evidence that something has changed, that smart money may be rotating or exiting. Here's how to apply this practically.
You're watching the Euro USD on the 4-hour chart. Price has been making higher highs and higher lows consistently for 3 weeks. Then price rallies to a new high, but the candles are smaller. The volume is lighter.
That's your first flag. Then price pulls back, and this pullback breaks below the previous higher low. That is your CHoCH. At this point, you do not short immediately. The CHoCH is an alert, not a signal. What you do is zoom into the lower time frame, the 1 hour or 15-minute, and look for a fair value gap, an imbalance in price where orders were left unfilled, a liquidity grab, a spike through a previous low that traps stop losses before reversal, a lower time frame BOS in the bearish direction, confirmation that smaller participants are also shifting. When all three align with a CHoCH on the higher time frame, that is your institutional grade entry signal. Two more concepts that are non-negotiable in this framework: order blocks and fair value gaps. Order blocks are zones on the chart where institutional orders were placed in significant quantity. The simplest definition: an order block is the last opposing candle before a significant impulsive move. If price makes a sharp rally upward, the last bearish red candle before that rally is your bullish order block. That's where institutions placed buy orders. When price returns to that zone, institutions often defend it again. Why does this work? Because large orders don't all get filled at once. When a bank buys aggressively, some of that order may remain unfilled. When price retraces to that level, they finish filling, creating a reaction. Fair value gaps, or FVGs, sometimes called imbalances or inefficiencies, are three candle patterns where price moves so quickly that the wicks of candle 1 and candle 3 don't overlap. This leaves a literal gap in the order book, a zone where price never properly traded both sides. Markets have a mechanical tendency to revisit these gaps as they represent unfilled orders on one side. In practice, when you identify a bearish CHoCH, drop to the 15-minute. Look for a bullish FVG that formed during the prior upswing. That gap is a target. Institutions will often run price back through it before the real move down begins. That's the liquidity grab before the markdown. These are not arbitrary drawing tools. They're representations of real institutional mechanics, where orders were placed, where price moved too fast to clear the book, and where money is likely to return. Let me give you a concrete step-by-step workflow that you can apply to any liquid market: stocks, futures, forex, crypto. Step 1, establish higher time frame bias, daily or weekly. Before you touch an intraday chart, define the structural trend on the daily. Is price making HH, HL? You're in a bullish structure. LL, LH? Bearish. Sideways range? Wait for a structural break. Step 2, identify key structural levels on the 4-hour. Mark your most recent swing highs and swing lows on the 4H. These are your structural levels. Note whether the last significant move was a BOS, continuation, or a CHoCH, potential reversal. Mark the order block that preceded the most recent impulse move. Step 3, watch for liquidity builds on the 1-hour. Liquidity pools form above equal highs and below equal lows. If you see 3 consecutive 1H candles printing similar highs, there are stop losses sitting just above those highs. Smart money will often sweep that liquidity before reversing. On a bearish day, watch for a spike above the equal highs. Then look for a sharp rejection. Step 4, execute on the 15-minute with confirmation. Once you have the higher time frame bias, the 4H structure, and the 1H liquidity sweep, drop to the 15-minute. Look for a mitigation of the order block, a lower time frame CHoCH in your intended trade direction, price respecting a fair value gap. Enter at the OB or FVG mitigation. Stop loss below the structural low for longs or above the structural high for shorts, and target the next structural level on the 4H. Step 5, let R multiple manage the rest. Minimum 1 to 2 risk to reward. Move stop to break even at 1R. Let the trade breathe. The institutional move, once confirmed, tends to be clean and directional. You don't need to micromanage it. I want to be honest with you about something that most trading educators won't say clearly. The market is not random, but it is adversarial. Retail traders cluster their stops at predictable locations, just below round numbers, just below previous swing lows, just above recent highs. Institutional algorithms know this.
They have the order book data. The liquidity sweep, the fake breakout, the stop raid is not a coincidence. It is a deliberate mechanism to fill large orders at favorable prices. When you understand this, your entire relationship with the chart changes. You stop chasing breakouts and start anticipating them and knowing they're likely traps. You stop placing stops at obvious levels and start building in buffer. You stop trading every setup and start waiting for the multi-timeframe alignment that signals genuine institutional commitment. Let's recap the market structure blueprint. Market structure is the sequential pattern of swing highs and lows, the foundation of all price analysis. BOS confirms trend continuation. CHoCH is the early signal of a structural shift. Institutions work in phases: accumulation, markup, distribution, markdown. Order blocks and fair value gaps show you where institutional orders exist on the chart. A top-down multi-timeframe workflow, daily to 4H to 1H to 15M, is the professional standard for trade execution. Liquidity sweeps are features of the market, not anomalies. Learn to use them as entry triggers. None of this is magic. It is applied institutional logic. The more time you spend studying structure on clean, indicator-free charts, the more fluent you become in reading what the market is actually doing versus what it wants you to think it's doing. If you found this valuable, subscribe for weekly deep dives into market mechanics. Drop a comment below with the market or instrument you want me to break this down on next. I read every one. See you in the next one.